and I wanted to first explain our role and responsibility as it relates to the differentiation of our retirement plan provider, which is retirement plan consultants. So our goal today is to talk about the 401k plan and help understand the importance of this benefit. So retirement plan consultants, I sometimes refer to them as RPC, just to shorten the acronym there. They're our provider, much like United Healthcare would be your provider on your medical side, or say Cigna or Aetna. Our 401k provider is RPC. So for those of you that have 401k accounts, that of course is going to be the web URL that you log into to see your accounts, do your enrollments, and manage your 401k is with RPC, Retirement Plan Consultants. So our role here at Alpha Capital Management Group is we're the 401k financial advisors that are assigned to your plan. And our role is twofold. The first and primary role is to make sure that all of the investment and mutual fund choices in your 401k plan are being monitored with a process and a procedure that the IRS likes to make sure that they're deemed appropriate to be selected into your 401k plan. So we've come up with that menu of choices for you to pick from when it's time to invest in your 401k plan. But also another important role that we fulfill is to do webinars and meetings like this with all of you to help you understand your 401k plan, be a real financial coach for you as you invest for your future, even to the point where you're able to call us, email us, one-on-one. We're happy to take those calls. You have all of our contact information on the page, and we're, again, wanting to make sure that we're transparent, that you can call us at any time as financial advisors to get help with your understanding of your 401k plan or anything investment related. So again, we have RPC, Retirement Plan Consultants, as a provider, and of course our firm, Alpha Capital Management Group, as your financial advisory firm. So with that all being said, we're going to talk about a few subject matter related items in your 401k plan, and our goal is to make sure that we only tie up about 30 minutes of your time so that you can move on with your workday. And so what I'm going to do is let Ian explain the plan highlights just as it relates to what does the eligibility and so forth look like. So I'll let Ian explain all that.
So as a follow-up, the materials that we'll be reviewing today, the presentation, the online enrollment packet, an asset allocation guide, and also a web participant kind of walkthrough of the website will all be available to you via an email from your HR team. So if you want to reference any of these documents that you have, your HR team will have that material and will be sending it out to you if they haven't done so already. Based off of the 401k plan details, there are some uniqueness of the plan, and want to make sure you are all aware of the uniqueness of the 401k plan. For eligibility, anybody who meets 90 days of service or 3 months of service and 250 hours will be automatically eligible, and then you will be eligible that start of the following month, and it will be monthly enrollment thereafter. So if you are eligible to participate in the plan as of, say, July 1, you can enter the plan that following month if you're a mid-month enrollment. There is a company match that's available in the 401k plan. It's a wonderful benefit. About 1 out of every 3 401k plans has a safe harbor match. So it's a great benefit to you as employees, as an incentive to get you to save, but also as a rewarding for a company match. The company match is a safe harbor match, and the calculation is 100% on the first 3% that you put in, and then 50% on the next 2% that you put in. The schedule is below of what the employee's contribution would be, and then what the company match would be. We would really educate and try to advise everybody to at least save 5% at a minimum, because that would then allow you to maximize that total 401k company match of 4%. If you do put in something greater than 5%, you will still max out at that 4% number. Inside of the 401k plan, you do have a couple of different contribution types available, which is a pre-tax contribution or traditional, or an after-tax Roth contribution. Depending on your tax bracket right now and income, one may be better than the other. A traditional 401k plan is probably the most common from what you all would create some familiarity with. A Roth contribution is going to be after-tax monies. We tend to see people that are in a higher tax bracket or looking for deductions in their taxable income would do a traditional contribution. For those who are in an earlier working years, maybe they're younger, and then they're in a lower tax bracket, they tend to do Roth contributions. Depending on your circumstances, one may be better than the other, and you can adjust that over time. So you could be doing traditional right now and then change it to Roth, or vice versa in the future. Nothing is set in stone. You do have flexibility in those choices. Same goes for your contribution amount. So if you're at 5%, you can change that up or down. If you're at 10%, you can change that up or down. Going back a little to the contribution amount, the national average for people saving in their 401k plan at all age groups is 8%. So try to use that as a watermark. If you are currently participating in the plan, look at your contribution rate and try to get up to that 8% level as a national average. A lot of studies have shown is that 10% is really the magic number from a replacement of income score and reaching your goals in retirement. So whatever we can do to try to shake you a little bit and get you to save a little bit more to go up from 5 to maybe 6, 7, or 8, or even go up from 8, 9 to 10, we'd really encourage that. And we'll also show you on subsequent slides how powerful that is. In 2018,
can I ask a quick question
ahead.
here? So for the traditional versus Roth, do you guys offer a percentage split, or does it all have to be traditional or all have to be Roth?
You have the option of splitting the difference if you would like. So if you're going to save, say, 6% of your compensation, you could do 3 and 3 if you would like. It does not have to be equal either. As a preference, the company match will always be a traditional contribution or a pre-tax contribution. So in the example, if you're going to save 5% Roth, that company match of 4% that you're going to get is always going to go into a traditional or pre-tax bucket. So you're almost hedging your bets in that example. Does that make sense?
Thank you. Yeah, it does. Thank you.
Okay, great. So again, the IRS limit of 401k contributions into your account is $18,500. Anybody over the age 50 can put in an additional $6,000 for a total of $24,500. The 2019 numbers have not quite yet come out. As that comes out, it will be updated. Our guess is it's going to be very close to that number, if not a little bit higher. For the 401k plan, depending on your accounts that you've got with other 401k providers at previous jobs, if they are something that you would like to consider of consolidating, there is a team at Retirement Plan Consultants that can help with that transition from that current provider over to your new 401k plan or your existing 401k plan. And vice versa. If you're no longer employed with a company and you're looking to transfer out your balance in the 401k plan, you can roll those monies out to the other 401k plan. It is very important to keep track of your 401k balances. I can't tell you, Mark can't tell you as many times that we've talked to participants that have literally lost track of their logins and the companies that have their 401k assets at other custodians. So keep track of your money, make sure you've got contact information updated, usernames updated, and you're getting that information accordingly. So if that is something that you would like to do, that information is on the presentation. The best number to reach at is there on the bottom, as well as Mark and I are available to consult with you over your options as well. I'm going to turn it to Mark to go over an example of your contributions.
So saving in your 401k plan is really designed as a program that the federal government and the IRS has come up with to make it as easy as possible. So for those of you that are currently enrolled, or for some of you, this might be something brand new that we're trying to encourage saving for retirement, the contributions into your 401k plan they're your monies. So as a financial advisor / coach, we're simply advising you to take care of yourself and to pay yourself first. And for some people, that might be a monumental task in the sense that we've got student loans, we've got car payments, we've got, rent, we've got mortgages, we've got kids and pets, and money gets stretched in 1,000 different ways. But I'm convinced as a financial advisor that at any compensation level and at any age, we can budget our current month to find some level of savings. And the reason why the 401k is important and it's easy to do is it comes right from your paycheck, goes into your account. In other words, most of us with direct deposit, we tend to find out that if that paycheck is deposited, we find a way to spend it to zero without any savings. But by virtue of paying yourself first with payroll contributions, it's out of sight, out of mind. And believe it or not, I wanted to share a calculation that's here on the screen that just shows you how nice it is to save with these pre-tax contributions into your 401k plan. So if you look at the box on the right, I like to use a $1,000 paycheck. Now, of course, we can do some easy math around that, and that's why I chose 1,000. If you were to contribute 5%, which is $50, and get the 4% company match, which is $40, you would have a total of $90 going into your 401k account off of just one payroll cycle. Now, being that it's pre-tax in this example, or say the traditional method, the government is only going to tax you on $950 of earnings. So that's where this pre-tax nature comes into play. So you're not being taxed on the full 1,000, you're only being taxed on $950. So that contribution is stuck away before it gets a chance to be taxed. So just given an average tax rate of 22%, what we're trying to convey here is that your net take-home pay roughly would be about $741, which is only about $40 less than if you had not contributed anything at all, yet you'll have $90 in your 401k plan. So if you're willing to give up a little bit of take-home pay for the ability to save for your retirement, all we simply wanted to do is give you a sample snapshot of what a paycheck would look like. So again, very, very important to pay yourself first. And these are your accounts. As Ian explained, they're meant to be portable as your working career rolls out, and essentially we're asking you to take care of yourself as your financial coach. And one statistic I can share with you is that most people in retirement, the 401k is so meaningful that it's about 40% of the monies that you're going to rely on in retirement. The other portions of what people rely on are Social Security, which is roughly about a 30% bucket. In other words, it's about 1/3 of what people would rely on in retirement. So now we're at 70. The other important bucket that you'll want to make sure to pay attention to is just your savings accounts. Any sort of investment or savings that you've had along the way that is ready cash or investments is the other 30% of how most people will do their spend down strategy in retirement, are those three very important buckets. So we're talking about an important piece of your retirement.
So for those who are not currently participating in the 401k plan, part of the documentation that will be sent to you via email is an online enrollment form packet. The steps to go and complete the online enrollment is very easy and straightforward. You will go to Retirement Plan Consultant's website, select online enrollment, and type in the plan password. The plan password is ASSAY, A-S-S-A-Y, all capital letters. There is a guided step document that's also part of that enrollment. There's a video as well. If you need help and assistance with enrolling online, feel free to reach out to us as well too. Including in that documentation that will be sent to you is also a participant web portal website guide that goes over the functions and the features inside of the Retirement Plan Consultant's website. Here's another couple screenshots of the participant website guide as well. Part of our ongoing education and advice to you as individuals is our asset allocation guide that comes out every single quarter. This will help you with that investment decision today, but also into the future. All of the investment choices available to you are listed here on that left-hand column. The asset class that they represent is in that second column, and the ticker symbol is in that third column. And part of that larger rectangle in the top, what Mark and I have done for you is created 5 model portfolios that each of you can follow based off of a risk tolerance. So depending on your age and risk tolerance and time frame left into retirement, one of those columns would probably be most appropriate for you. As an education, we tend to see people that are in their 20s and 30s would be in that more aggressive camp or that 80-20 mix. Into your 30s and 40s, even into your 50s, we tend to see people in that moderate aggressive column, or that second from the right. And then as we see people in their late 50s, early 60s, we'll tend to be in that moderate or 50-50 model, with preservation in mind as they've accumulated their balance. That top larger rectangle is going to be more of a hands-on approach because we will come out with this guide every single quarter for you to follow. The ask of you is to go in online and make those changes as we come out with updates on the allocation guide. So as an example, if we just change, this percentage from 5% up to 8% and we adjust something else, we'd want you to have that change reflective in your account as well. For those who want to be a little bit more hands-off, the target date funds are a great solution for you. The target date funds are very popular. About 80% of people that are saving in their retirement plan are saving in target date funds because they're that more autopilot mentality. The target date funds work in a similar fashion to the top columns. The 4 funds at the bottom that have the bigger the year indicates that you have longer time frame until retirement. What each of you would do if you're interested in the target date fund would be doing the math around what year it will be when you reach age 65. That's going to put you into one of these target date ranges in that second column, and that would fill you into that most appropriate target date fund. The 4 that I've highlighted in blue are going to be more aggressive in nature. They're going to have 80 to 90% in equities. And then the same goes as people get closer and closer to retirement. The next 4 here that I've highlighted, the 2025 to 2040, are going to have about 60 to 70% equities or 60-40, 70-30 mix to that moderate aggressive allocation. And then as you get closer to retirement, those next 3 that you can see here, they're close to the given year right now, and they're going to be roughly about a 50-50 portfolio or slightly less. So they start out aggressive, and then every 5 years they de-risk, ultimately becoming about a 50-50 portfolio in retirement. So we've got one option is a little bit more hands-on, following the guide that we put out every quarter. The second is to do a little bit more of an autopilot mode and selecting a target date fund and going with that. Whatever you decide today or into the future, you can adjust your investments at any time into the future every single day if you wish. There's no cost of going in and out of any of the funds as well. So I'm going to pause there. Are there any questions that either of you have about the information that we've covered so far? We wanted to kind of put a checkpoint and touch base with you guys to see if there's any questions. Okay. I know it's kind of hard to see on the screen right now. There will be a separate document that's a single sheet that you can see this information in clear form. We also will be coming out with a new updated document here in about a week or so as we get the investment information from the fund families every single quarter. This is the July one. The October one is not quite yet ready. We should have that kind of around the 15th to the 18th of this week, and then we'll be sending that out in a few days. So keep an eye out for that other communication that will be coming out as well. I'm going to turn it back to Mark just to talk a little bit more about retirement savings and the importance of it.
Thanks, Ian. We have about 10 minutes before we wind up our half hour. So we're going to share a few slides on investor education and just the importance of time and value of compounding of money and the importance of saving often, staying disciplined and starting as early as possible. So on this particular slide, we have investor A, B, and C. And typically what we like to do is map out what does my money look like in the future. No one really gets excited about that first $100 contribution. But again, we have to start somewhere. Most of you do have active balances in the 401k plan, and you're on the right track. But for those of you that have not enrolled, this is very important that you take those next steps to start saving for your retirement. So investor A, which is green, was an individual that at age 23 decided to save for 9 years and simply saved $5,500 a year for those 9 years and then stopped. And with the compounding and investment earnings on those dollars at age 65, with an annual expected return of around 8% per year, which is our market average, ended up having a balance of around $940,000. Now, many of you might fall in investor B category, which is the time frame where this individual did not start saving until the age of 32. And the reason why we see that somewhat common is because many people have student loans, they have car payments, there's lots of obligations with maybe starting salary incomes early in their career and just weren't able to save. So in the blue middle box, this individual saved the same amount of money every year, which was $5,500, but for more than 3 times, 4 times the length of period of time, for 34 years instead of 9. And even in that late start, at age 65, actually wound up with a little bit less money than investor A at $872,000. Now, ideally, investor C, for those of you that are in your 20s, ideally you would want to start saving, because if you can capitalize on 42 years of saving $5,500 a year for that length of time, you're going to have just short of $2 million based on normal market expectations. So anyway, just a real simple slide on the power of time and the power of earnings in your 401k plan.
Part of our conversation earlier was putting in at least 5% to get that company match of 4%. The green line here on this chart will indicate an individual saving roughly 5% of their income and not changing that contribution. The red line indicates that same individual starting out at 5%, but then increasing that contribution from 5 to 6, 6 to 7 in those following years, and then at year 5, that individual saving 10%. So the difference between the two participants is that roughly about that in between that 5-year and 6-year mark, the green line, the individual still saving 5%, the red line, that individual saving 10% of their income. With that annual contribution increase, you can see those values are very different. The green line, roughly about $18,000, the red line, roughly about $30,000. So almost double the amount of money in just a 10-year period of time that individual was able to save. Now, what's also important is if we look at this as, a 30-year, 40-year investment accumulation, is if we extend those lines, that red line out to 30 and 40 years, that's going to be very steep and high to the right, whereas that green line is just going to be more, low to the right as well. So it's very, very important to consider what you're starting out today at. Yes, that's good, but try to encourage yourself to at least bump that contribution up by 1% every year, or on an anniversary or some sort. That 1% increase really, really is hardly ever felt at your net take-home pay. So definitely keep that in mind as you're evaluating what contribution rate you're going to be saving in.
Another important piece of investment education that we want to convey to make the most use of our time is to talk about market timing. So when we go home, we typically hear the news, and there's usually a small business segment of whether the markets did really good today or not so good today. And essentially, we in the 401k world are typically wanting to kind of have you steer away from the emotions and the news media, because these are long-term investments. And we don't want to get caught up into what we call market timing. In other words, there are some individuals, I'll use 2008 and 9 as an example, where we have the last great recession, where they were looking at their account balances, and if you were fully invested, it was not uncommon to see a 40% loss in your 401ks or your IRAs or any other outside investments that you might have had. Well, what happened with those people is because they couldn't palate all that change, they would get out of the market and put things in cash until they essentially could figure out what was going on. Well, what those individuals did was because they sold and got into a cash account, they basically locked in the losses. And when the market started to rebound from 2009 to current day, we've been on the longest bull run ever. Who knows when they decided to start investing again, but most likely missed out on a lot of the advances in the market. And not only did they lock in the losses, but they also missed out on all the gains. So market timing is the holy grail of investing. And I would not be on the phone with you. I would own an island somewhere if I knew when the markets were going to go up and down. There's no way to know that. If anybody did say they knew that, run the other way. So what we want to do in the 401k world is, if you've got a 10, 15, 20 plus year work horizon, is to stay fully invested in the markets and ride these things out. Because when the markets go into recessionary times, they could last a couple of years. But with your payroll contributions, you're buying these mutual funds on sale. And we're using what's called dollar cost averaging to buy into these mutual funds at a reduced cost. So when they do rebound, you're going to capture all of that upside and then some. So that's our best strategy moving forward. So looking at this slide, over a course of a 20-year period of time, we can see that $10,000 will turn into $40,000 over the course of 20 years with normal market expected returns of around 8%. But the key here is not the left-hand gray box, it's the second box in. You can see that if you were to miss just 10 of the best days in the market, those are the 10 best days where the markets went up the highest amounts in any single given work day, just 10 of those over 20 years, that's over 5,000 Monday through Friday trading days, that your portfolio return would be cut in half. And so since we don't know when those 10 days are, whether they're the best ones or even the worst ones, we cannot market time. So as you can see with the other 4 bars, if you miss 20 days, 30 days, 40 days, it just continually gets cut in half. So highlighted in blue is something that's a very interesting fact when you're an investor that may hold true, and that is 6 of the 10 best days occurred within 10 days of the worst days. So even though you might hear bad news tomorrow that the market's tipped upside down, sometimes the best days in the market can be within 2 weeks of that worst day. So again, they sometimes can happen in close proximity, and we don't know when they are. So rather than trying to time it, stay disciplined with your investment approach in that risk tolerance model that you're most comfortable with and maintain course.
Hey guys,
thanks, Mark.
Can I throw in just a personal story here on that same front?
Absolutely, we'd love to hear it.
So my parents were public school teachers in Southern California, and when we had the last big market crash in I would say the early 2000s, my mom panicked and sold off her retirement and lost 40% of what she spent 35 years saving. Less than 2 months later, she would have gotten 90% of it back if she had just simply stayed in the market, and she panicked and sold it the night that it came out that there were all these massive like .com changes. So that's one example of how my family took a very serious hit from my parents' retirement by panicking, and she worked for another 5 years. So if she had just stayed in the market for another 2 months, all of that loss would have been completely mitigated and they would have been totally fine. Whereas now she has to take a part-time job since she's retired to kind of make up some of that gap. So it's just one of those things that like I can say from personal experience, if you can stay in, because otherwise it hurts.
Yep.
So it's a great story, and thank you for sharing that. We're getting to the point where we've used up most of my time, but here's something that's really important that maybe I can end with, and that is what do the markets look like as financial advisors? What can we convey to you to give you some confidence as to what the next 6, 12, or even 18 months look like? So here's the general consensus of all of the research materials, and we're in this day in and day out. Certainly not a guarantee, but it's our crystal ball look that the markets look very, very favorable for at least another 12 months, potentially up to 2 more years. And the reason why there's sentiment of the economy moving forward and that there will be positive investment gains in your 401k plan is because primarily of all of the leading economic indicators, such as job growth, corporate earnings, wage growth, there's low unemployment, interest rates are in check, oil, gas is fine. Our gross domestic product is on all gears right now, doing well. The tax reform is probably the underlying factor that's going to drive most of this forward as we get to file our individual household tax returns in January, February, March, that we'll see the benefits at an individual household level as we file the returns. That was something that was passed last January. So as we still continue to see momentum in the economy, we don't see any reason to be pessimistic about market returns. We know there's going to be volatility, i.e. when we say volatility, that's the market going up one day and down the next. That's normal business cycles that we have to be emotionally able to handle and accept. But seeing 2, 3, 4%, market averages around 8. Ideally, we're going to see positive returns in our market for the next 12 to 18 months. If there's any change, we're going to make sure to convey at least some sort of communication out to you. And if there's any concern, you can give us a call and we'll get more specific around your own investment picture and horizon.
Thanks, Mark. I actually wanted to show something that was quite interesting. I actually read that this morning. This is just a piece that happened between the last, almost 100 years. This is an example of the market downturns happen frequently and don't last forever. So thank you for sharing that story. I know that was very hard times for your family, but it is something to be aware of as markets do go up and do go down. As this slide indicates, market downturns are frequent. As you can see here, the time frames, it happens, a decrease in the market of 5% happens roughly about 3 times per year. A 10% decrease about once a year, 15% decrease almost once every 2 years, and then a 20% move or more happens roughly about every 4 years. So we've been in a 9-year bull run, and actually has gone up even much higher over the last couple months and weeks to ultimately to higher highs as well. So be mindful of that. We want to make sure you're taking appropriate risk in your 401k plan, but not unnecessary risk. Both Mark and I are available to talk with you one-on-one if you would like to discuss your 401k plan in greater detail or the investments that you have, and we can help lend some advice and education to you. We'll open it up for any final questions, and we'll look forward to following up with each of you via our quarterly communication, and look forward to talking with you if we have the opportunity to. So are there any other final questions that anybody has about this?
Just one question. For the market asset allocations, the quarterly reports, where are those published?
So they're going to be sent to your HR team, and then the participants in the 401k plan or the employees will be getting an email with that communication.
Perfect. Thank you.
No problem.
I appreciate everyone's time and attention today, and I know you've all got a busy day, so we look forward to further conversations in the future, and we'll let you guys all run and have a great day out there in Southern California.